Welcome to Decode Station. I'm Sarah. Tonight, we deconstruct the biggest lie in financial history, a $65 billion illusion that fooled the world's elite for decades. Marcus, how did one man keep a $65 billion lie alive for 20 years without a single trade? Was the SEC asleep at the wheel, or was Bernie Madoff simply a mathematical genius of fraud?
Thanks, Sarah. This wasn't just a Ponzi scheme. It was a masterclass in regulatory failure and psychological manipulation.
Masterclass is, it's a heavy word, but when you look at the sheer duration of this thing, it really feels appropriate. I mean, we aren't talking about a scam that lasted 18 months before imploding.
Yeah.
This went on for decades. But before we get into the psychology of the con, our mission today is to really dig into the mechanics of this illusion. We're looking at court documents, SEC filings, and whistleblower accounts. And we need to ground this in the numbers first because, well, 65 billion is a hard number to wrap your head around.
It is. It's an unfathomable amount of money for a single fund, but we actually have to be really careful with that number.
How so?
Because that 65 billion figure is actually part of the illusion itself. When we look at the official criminal case summaries from our sources, that was the amount shown on the client statements at the very end.
Oh, I see.
It was paper wealth. It was fantasy money that literally never existed.
So that figure was just what he told people they had.
Exactly. The actual principal lost, like the real cash that you or charities or banks wired into his accounts and never saw again, that was estimated to be between 17 and $20 billion.
Which is, I mean, still a staggering amount of money to just vanish into thin air.
Oh, absolutely. But the gap between that 20 billion in real cash and the 65 billion on paper, that gap represents the false profits he invented. It represents the lie.
Right. And to understand how he sustained that lie for you and all the other investors who thought they were making a fortune, we have to talk about the mechanism. You called it a Ponzi scheme.
I did, yeah.
I think most of our listeners know the basic definition of that. Robbing Peter to pay Paul.
Using new investor money to pay off earlier investors who want to cash out, rather than generating profit from actual legitimate business activity.
Exactly. But this operation was different. It wasn't some guy in a basement promising to double your money in a week, right?
Far from it. And that brings us to the first really crucial piece of this puzzle, the trusted titan. He didn't present himself as a get-rich-quick scheme. He presented himself as the safe harbor.
Right, because he was the establishment. He was the former chairman of the NASDAQ.
Yes. He sat on regulatory boards. He was a pillar of Wall Street. And this is a critical point from the sources. He ran a legitimate business alongside the fraud.
Okay, wait, so he actually had a real business.
He did. The documents refer to it as System 1. It was a wholesale market-making business. It was highly technologically advanced for its time, completely legitimate, and it made real money.
So he had a day job that was actually successful.
Very successful. And it acted as the perfect shield. Because regulators and investors, they saw this legitimate trading floor of System 1 screens flashing, traders shouting, real volume. And they just assumed the investment advisory side, which we'll call System 2, was just as real.
It provided cover, but there was also this incredible element of social engineering. Reading through the background on his client list, it wasn't something you could just sign up for on a website.
No, and that was the trap. He completely weaponized exclusivity. It's a concept investigators often call affinity fraud.
Affinity fraud.
Right. He targeted specific, tight-knit communities, wealthy Jewish communities in New York and Florida, exclusive country clubs. And the pitch wasn't, please give me your money.
It was the opposite, wasn't it?
Exactly. It was more like, I'm not really taking new clients right now, but maybe if you know the right people, I can squeeze you in.
That is brilliant. And diabolical. He turned the victimhood into a privilege.
Yes.
You felt lucky to be scammed.
Precisely. It created this intense fear of missing out among the elite. If you were in the fund, it was a status symbol. It meant you were on the inside. And once you're on the inside, you don't ask too many questions because you don't want to walk the boat and get kicked out.
Trust was the currency. But eventually, people do look at their statements. I mean, you want to see performance. And this is where we get into the illusion of stability. You mentioned earlier that he wasn't promising to double money overnight.
Correct. The returns were boringly consistent. He promised steady annual returns of approximately 10 to 12%.
Which, to be fair, is a great return. But the S&P 500 has years where it's up 20% and years where it's down 15%.
You just went up. It was a smooth, upward trending line.
Just a smooth line.
Exactly. In a volatile market, a 45-degree angle on a chart is unnatural. It does not exist in finance. But when clients or feeder funds asked how he did it, he had a very specific technical answer ready. He called it the split strike conversion strategy.
Okay, let's unpack this, because this is the technical heart of the lie. It sounds highly sophisticated, which I assume was the point, to make people's eyes glaze over so they stop asking questions.
That was definitely part of the psychological manipulation, yeah.
But looking at the breakdown in the source material, the logic of the strategy actually makes sense on paper, doesn't it?
It does. It's a well-known hedging strategy. The theory is totally sound.
So, step one, he buys a basket of blue chip stocks, basically S&P 100 companies.
Right. Your General Electrics, your Coca-Colas, that's the base. But obviously, if the market crashes, those stocks lose value. So step two, he buys put options on the index.
Which acts like insurance.
Exactly like insurance. If the market drops, the put option increases in value, which offsets the loss on the actual stocks.
But insurance is expensive. Buying those puts eats into your profits. So step three, he sells call options.
Yes, he sells the potential upside. He finds someone willing to pay him for the right to buy the stock if it goes super high. So he uses the income from selling the calls to pay for the insurance of the puts.
So he creates a caller. He can't lose much, but he can't win much either. It's supposed to be a low volatility strategy.
Precisely. And that is exactly why the 10 to 12% return seemed plausible to the layperson. He could sit there and say, I'm not gambling, I'm hedging. The problem wasn't the logic of the strategy. The problem was the scale.
This is where the math breaks. Because independent analysts later looked at the volume of options you would need to execute this strategy for $15, $20, or $65 billion.
And the numbers were literally impossible. To execute that strategy for the amount of money he managed, he would have needed to buy more put options than existed in the entire global market.
Wait, he would have needed to corner the entire options market.
He would have needed to be the entire market and then some. It was a physical impossibility. If he was actually making those trades, every single trader on Wall Street would have seen this massive whale moving through the market every month.
Right.
But nobody saw anything.
Because he wasn't doing it.
He wasn't doing it at all. The SEC and clearinghouse records confirm that no corresponding trades were ever recorded. The entire split strike narrative was a fairy tale designed to sound boring and safe.
So if he wasn't trading, what was happening in System 2? You mentioned the legitimate side had traders and screens. What did the secret side look like?
It was a factory of lies. Our sources describe it literally as a separate floor with a separate computer server, an old IBM AS400 that was ancient even by 2000 standards. And the employees there weren't hotshot traders. They were basically data entry clerks fabricating the past.
Fabricating the past. It sounds almost sci-fi.
It was incredibly low-tech, actually.
Yeah.
They would look at historical stock tables, literally just old data feeds or newspapers, and pick a stock that had performed well the previous month. Then they would backdate a trade, pretending they had bought it at the low and sold it at the high.
So they were betting on horse races that had already been run.
Exactly. They'd say, oh, we need to show 1% gain for this client this month. Okay, let's pretend we bought IBM on the 3rd and sold it on the 18th. The ancient computer would then generate a beautiful, official-looking statement, and they would mail it out.
And because System 1 was a real, massive broker-dealer, auditors and regulators just assumed the paperwork was legit.
They did.
But this brings us to the most frustrating part of the whole deep dive. Because if the math was impossible and the volume was invisible, surely someone noticed.
Someone did. And this is where we get to the warning signs.
Harry Markopolos.
The man who screamed into the void. Markopolos was a quantitative financial analyst, a quant. He worked for a rival firm that basically wanted to replicate those amazing results. His boss told him, figure out what he is doing so we can do it too.
So he sits down, runs the numbers on the split strike strategy, and
It took him about 5 minutes to realize it was a fraud. He looked at the return curve, that smooth 45-degree line we talked about, and he knew immediately. Markets are volatile. The returns had zero correlation to the market. Mathematically, it was impossible.
he didn't keep this to himself. He went to the SEC.
Repeatedly. Between 1999 and 2008, he submitted multiple detailed complaints. The most famous one was a 2005 submission titled, very subtly, "The World's Largest Hedge Fund is a Fraud."
You literally cannot be more clear than that. I mean, he handed them the gun, the bullets, and a map to the body. Why did the SEC miss it?
It was a true masterclass in regulatory negligence. But we have to look at why they failed. It wasn't just laziness. It was a complete lack of capability. The SEC examiners who went in were mostly lawyers, not quants. They didn't understand complex derivatives or option strategies.
So when he started talking about split strike conversion and collars, they just nodded along.
They were outgunned. And he knew it. He would bully them. He would drop names. He would look at them and say, I'm the former chairman of the NASDAQ. Do you have any idea who you're talking to? And the junior examiners would just back down.
That is infuriating. But there was also a massive structural red flag that Markopoulos pointed out, which I find completely baffling: the issue of the custodian.
Yes, this is the due diligence failure of the century. In a normal hedge fund, there is a separation of powers. You have the investment manager who makes the decisions, but the actual money is held by an independent bank custodian.
Right. So if the manager says, I have $1 billion, you can just call the bank and verify it.
Exactly. But in this case, he was his own custodian.
Unbelievable.
He held the money, he made the trades, and he printed the statements. It was a closed loop. He was grading his own homework for 20 years.
And the SEC let it slide because of who he was. It's terrifying to think that the supposed watchdogs were essentially asleep on the porch while the burglar emptied the house.
They weren't just asleep. They were being served tea by the burglar.
Wow. So the regulators fail. The investors are happy because they think they're making 12%. The scheme is growing. But Ponzi schemes have a fatal flaw. They need fresh blood. They need constant new money to pay the old money.
Always. And that brings us to the collapse. The catalyst was the 2008 financial crisis.
A completely external event.
Right. The entire global liquidity crisis hit. The financial system basically seized up. Lehman Brothers collapsed. Panic swept the market. And when investors panic, what do?
They pull their cash.
They want liquidity. In late 2008, these elite investors who had lost their shirts elsewhere in the market crash started calling in to withdraw their safe funds. They needed that cash to cover margin calls or just to survive.
And this is where the math finally broke.
It shattered. The requests for withdrawals surged. We're talking something like $7 billion in requests in a matter of weeks. He didn't have $7 billion. He had a few $100 million left in the bank account. He was scrambling, trying to raise capital from anywhere, but the markets were completely frozen.
The detailed accounts of those final days from the sources are just intense. He was watching the walls close in. And ultimately, he didn't get caught by an audit. He didn't get caught by the FBI kicking down the door. He told on himself.
He had to. The game was up. On December 10th, 2008, he confessed to his sons, Mark and Andrew, who worked in the legitimate System 1 side of the business. He sat them down and told them, it's all just one big lie.
Can you imagine that moment? Your father, the legend of Wall Street, telling you that the entire empire is a hologram.
It completely destroyed the family. To their credit, the sons went straight to the lawyers and the authorities. They turned him in. The next morning, December 11th, the FBI arrived at the penthouse. He was in his bathrobe. And he simply said there was no innocent explanation.
And just like that, the illusion evaporated. $65 billion gone.
Which leads us to the aftermath. The scale of the devastation was immediate. He pleaded guilty to 11 federal felonies: securities fraud, money laundering, perjury. He didn't even try to cut a deal.
And the judge didn't show any mercy.
None. He was sentenced to 150 years in prison. It was symbolic, effectively a life sentence. He died in a prison hospital in 2021.
But while he was sitting in a cell, the victims were dealing with the fallout. And I think we really need to emphasize who those victims were, because there's this lingering narrative that he only stole from the ultra-wealthy, that this was just rich people problems.
That is a very dangerous misconception. Yes, there were celebrities and billionaires, but there were also union pension funds. There were university endowments. And most heartbreakingly, there were charities.
The Elie Wiesel Foundation for Humanity lost nearly everything.
Exactly. Charities that were funding medical research, education, poverty relief, they were wiped out overnight. Some had to close their doors entirely. The ripple effect went so far beyond Wall Street and exclusive country clubs. People lost their life savings, their homes. There was severe psychological trauma, depression, even suicides. The human cost was devastating.
It really was. There is, however, a complex twist in the tale of this story regarding the recovery of the money. Usually in a Ponzi scheme, the money is just gone. It's spent on yachts and private jets. But in this case, a significant amount was actually recovered.
It's the most successful recovery effort in financial history. The court appointed a trustee, Irving Picard, to claw back the assets.
Now, clawback lawsuits are a controversial topic. Can you explain how that worked? Because he didn't just find hidden bank accounts, he actually sued other investors.
Right. And this is the moral gray area that is still debated. Picard divided all the investors into net winners and net losers. If you put in $1 million and took out $2 million over the years, you were a net winner. Picard argued that the $1 million in profit you took out wasn't real. It was stolen money from other victims.
So he sued people who thought they were just spending their own legitimate investment earnings.
Yes, and many of those people had already spent the money on homes or retirement. They had no idea it was stolen. But the law is clear in these cases. You cannot profit from a fraud, even unknowingly.
That is harsh. But I guess from a fairness perspective, it's the only mathematical way to redistribute funds and pay back the people who lost their entire principal.
And it worked. Through these clawback lawsuits and massive settlements with banks that enabled the scheme, the trustee has recovered over $14 billion, something like 70 to 80% of the actual lost principal. That is completely unheard of in financial fraud.
So we have the crime, the collapse, and the cleanup. The question that you have to ask at the end of a deep dive like this is the system safer today? We have new rules now, don't we?
We do. The system is undeniably safer than it was in 2008. The biggest change is the custody rule. Investment advisors now face much stricter controls. It is very difficult to be your own custodian now. You absolutely need third-party verification.
So checking your own homework is no longer allowed.
Effectively, yes. And the SEC expanded its enforcement authority. They have much better whistleblower protection programs now. If a Harry Markopolos walked in today, he would likely be taken far more seriously.
But I hear a but coming.
But fraud evolves. We are always fighting the last war. This scheme was analog. It was paper statements, sticky notes, old computers. Today we have decentralized finance, complex algorithmic trading. These are highly complex, opaque systems that regulators still struggle to fully understand.
It feels like the same dynamic. The innovation always moves faster than the regulation.
Always. And remember, the SEC didn't catch him. The market crash caught him. If the 2008 liquidity crisis hadn't happened, or if he had been able to secure a bailout from a hedge fund friend, that scheme might have run for another 5 or 10 years.
That is the terrifying thought. The system didn't work, the system broke, and the breakage is what revealed the rot. Which brings me to a final thought for you listening. This wasn't just a failure of spreadsheets and regulators. He exploited a very fundamental human desire. We all want certainty in an uncertain world. We want that smooth line going up without the stomach-churning drops. But nature and markets don't work that way. As long as we desperately want to believe in a risk-free reality, there will always be someone waiting in the wings to sell us the illusion.
That is absolutely true.
Stay curious, stay skeptical. Goodbye.